Hello there. How are you?
Hi, merhaba. Um,
Merhaba.
Great to have you with us. Teşekkür. Thank you so much. Let's. I know you have a presentation as well, so we'll come back at in about maybe 10-15 minutes and have a bit of a Q&A as well. Thank you.
Sounds good. So I might take a little bit longer than 10 minutes, but I'll try to keep it under 20. What I want to talk to you about today, first of all, thank you so much for being here, and it's a pleasure to speak with you. And I have had a look at the agenda, and it's just amazing the kinds of topics there are and the kinds of speakers. So I'm honored that you have invited me. What I'd like to talk to you about today is the rise of platforms and kind of what that means for us as consumers, but also as entrepreneurs. So first of all, thinking about platforms, what we need to realize that even pre-COVID, platforms have been disrupting large enterprises in terms of their business model. Pre-COVID, this was 30%. It has increased up to 50% at this point, which means that businesses that were operating and making profits in the last 10 years are going to be struggling now because of new entrants and because of new technologies and new ways in which customers like to behave. And this also means that there's a need for businesses to understand who else is around them in order to connect to and in order to share data with, because, in today's day and age, we generate data the moment we step up, literally. Like if I get up from my chair right now, my smartwatch is going to tell me that I have increased my steps, and that's going to increase my fitness. And if it's connected to certain services, then it might even affect my health insurance. And so understanding how traditionally separate businesses are now part of a bigger ecosystem is very important and often missed. As customers, though, what this means to us is that we are actually understanding that when we give data, this needs to come to us in terms of better analysis and better, more tailored services. Just like, if you go on Amazon, Amazon every day, if you shop more and more, knows more about what you might like. And there's actually a project that they have, which is they ship and then you shop. So shipping before shopping, which means that things will come to your home and you will be deciding whether you want them or not. And if you don't want them, there will be a very seamless way to return them. I'm not saying this is a great idea, but this is officially a project that they're working on. Now, all of this means the rise of kind of the importance of data and the way that everything that we do has a digital meaning and digital footprint now increases the rise of platform businesses. And what we see is that platform businesses, they're not new. Uber is already over 10 years old. They have surpassed BMW, as you see here, in terms of market cap without owning a single car. Airbnb similarly doesn't own any real estate and has surpassed Marriott in terms of market cap. The list goes on this way. What we see overall is that what gives rise to the dominance of platforms, which basically means that in the last 10 to 15 years, they have risen from being kind of somewhere in the top 20 in terms of highest revenue businesses to occupying the top 5. As you see here at the bottom of your screen, in 2017, what we call GAFAM firms or tech titans have started to have taken the top 5 in terms of revenues. What is a platform, though? A platform is not necessarily just Uber or Airbnb or a payment platform. A platform is something. This is in fact from my village in Turkey. A platform is simply a place where different kinds of people, different kinds of entities come to interact. And this can be because they want to share information. It could be just, you see, in the street bazaar, which is, say every Monday. They close off a street, and I'm sure you're all familiar with this. This is where buyers and sellers meet, right? So the idea of a platform is, if you move away from its digital nature, the idea of a platform is to sell matchmaking, to do the matchmaking, and therefore to reduce your transaction cost. Imagine in a world before Uber, not saying Uber is great in every way, by no means, but before Uber, getting a taxi on the street sometimes is very difficult. With Uber, that difficulty has greatly decreased. And it also made it possible for us to potentially get better taxi services because we can now rate the taxi driver, whereas before this was not possible. Now, the rating system, as well as the immediate availability, using the information system in order to give tailored, customized services is actually what platforms are good at. What makes platforms also very special is that they grow very quickly once they get a few members. The reason for that is something we call network effects. Network effects basically mean that, imagine I have two kids who are in primary school, and the mothers and fathers have to coordinate certain things like, oh, do we need to make them wear a uniform tomorrow, or when is sports day, etc. If I go on Facebook Messenger in order to talk to these other parents, but if they have a WhatsApp group, then I'm completely irrelevant. But if I join WhatsApp, then because they can share information with me, the value of WhatsApp for them increases, even if it's just a tiny bit of increase. We call this the network effect. Every member that joins a network increases the value of being in that network for everyone else. And there's a very important type of data-driven network effect, which is going to be the focus of my talk today, which you see at the bottom in the white rectangle, where if you have more users joining a platform, say Uber, then you get more data about where these users are and when they'd like to travel, etc. You can train your algorithm with this and make sure that you provide the incentives for your drivers to be in the right place and to also cover demand when demand is low but still there. And this actually ends up creating a positive feedback cycle where products get better and better because the data of every new member trains the algorithm. What I want to tell you about is actually a very important case, which is happening everywhere in the world, in Romania, in Turkey, in the UK. And this is the case of platforms disrupting even regulated industries such as banking, healthcare, education. My talk today in the next 10 minutes is going to be focused on the banking sector, because this is where I have done the last, in the last 5 years, I have done my research on. And I'd like to bring you some of my findings, which are not yet published. So you're getting them fresh out of the oven. And these basically will give you a sense of how tech titans might have an advantage in banking, even though regulators might not be favoring them or might be trying to keep them out. My story begins with something called open banking and PSD2. I'm sure many of you have heard of PSD2. What this means is that it's a regulation, first of all, and it's a regulation that gives you access to your data in a financial institution, meaning if I have a bank, I work with HSBC, and before I could only access HSBC through my phone's HSBC app. However, in open banking, if I decide to give access to another player, for example, my cousin has a fintech and they're going to analyze my data and give me a better mortgage for a house I want to buy, then I might decide to share that data with the chosen fintech, and that's going to happen even if the bank doesn't want it, meaning it's going to happen electronically through APIs once I give an electronic consent to it. This has been in effect in the UK and in EU since 2018. It doesn't mean that it works perfectly, but it has been, UK and EU have been pioneers in this. And now we see it in places like Australia, Brazil, Canada, India, Mexico, Singapore, and Turkey. And I've looked up a little bit what stage the PSD2 or open banking is in Romania. And it seems to be getting traction lately, particularly with the announcement of major players last year to build a collaboration. And then also with fintechs coming in and actually setting up APIs in order for data exchange to start to happen. So it's definitely gaining traction. And although it's not perfect, it is very much the future of banking. However, what does this mean strategically? What is it for a consumer that the open banking regulation brings? What it brings is really more choice, right? What it brings is the availability of all these different fintechs for us to consume services from, which wasn't available before. You either had to go to one bank or another bank or another bank, and their services were more or less equal because they didn't feel any need to innovate because customers were sticky. They did not change bank accounts. However, the situation is slowly changing. And some of the players that we see in Europe gaining traction are, for example, digital banks like Monzo and Starling and Revolut, I'm sure you're very familiar with, and Atom Bank. What these guys do is they try to offer banking services to you and trying to replace your HSBC or Lloyd's or your national bank, basically, right? However, what we see is that there's quite a bit of struggle still in the system. And the struggle comes from the fact that banking is a sector where data is highly sensitive and customers are afraid of playing with data and with assets. This means that it's difficult for a new player to gain customers. However, even if they get customers to sign up on the app, so for example, I have Monzo and Starling installed on my phone. However, I don't deposit my salary there. I don't put my savings there. What I do is I put, £100 in each of them in order to basically kind of see what kinds of things they can do for me. And what this means is that these new players actually have a low average revenue per user. And that means that they have a really difficult time growing and breaking even. And what we see is that when they don't get enough revenue, they also cannot invest into making their systems resilient. And that means that they actually have system failures, which means that some of these players have their system down for an entire weekend, which means that you can't, if you have visited in a pre-COVID world, if you visited a different country, you actually can't make payments for an entire weekend, which is horrible. And that will reduce your trust into the organization. So overall, what's happening is that new players are struggling. They're trying to grow internationally because they don't get enough customers per country. But that's difficult too, because if you want to offer pensions, it has different regulations in Romania versus in Bulgaria. And if you want to do investments and tax returns, for example, it's completely different in the UK compared to Germany. And so what we see is that a lot of these guys decide that, reaching customers and doing a B2C format is actually too challenging in this market, and therefore move to a B2B model. I hear a bit of echo just now. Hopefully it will not continue, but let's give it a chance. Another thing that I see is that they try to partner with big banks because that's where the customers are. Big banks have millions of customers, and that's a gold mine for the new entrants. However, big banks are not ready to work with them because they have IT structures that are ancient and legacy, and they actually cannot connect a fintech easily to this structure. They also have a corporate culture which is afraid of data. One of my bank executive friends actually told me data for us is biohazardous waste. We'd like to contain it, and we don't want to even open that box because we're afraid something bad is going to happen and we're going to be liable for it. And they also don't want to share their customer with these new fintechs. And another friend of mine actually told me, we don't want the bank app to look like NASCAR with all these different logos. We want it to just be us. But that is not in the spirit of collaboration, as you can imagine. So overall, my conclusion is that for fintechs, as you see in the quote on the left, if they try to work with a bank, for example, win a fintech challenge or a hackathon in order to be featured by a bank, that's actually a sure way to run out of money because then the bank gets interested in them, but their IT structure and their culture actually really prevents a collaboration from happening quickly, meaning the fintech is spending their resources onto that collaboration without actually being onboarded, and in the meantime, just running out of money. And on the other hand, banks basically say, look, I don't want to kill my own products, and therefore I'm only going to collaborate for things that I don't do in-house myself, which means that all these fintechs that offer better analysis for kind of personal finance management tools, etc., too bad, because the bank actually doesn't want that to compete with their own services. Overall, if we compare the situation of a new entrant into banking compared to an incumbent, as you see on the opposite ends here, a new entrant has the advantages of being able to use data because they're digital born. They can give cheaper, better services. However, because of the data sensitivity and asset sensitivity, customers don't trust these guys. And their systems, therefore, cannot be resilient because they don't earn enough to really build a robust technology architecture. And they cannot necessarily grow internationally very easily because their products are dependent on local regulations. On the other hand, incumbents banks also struggle because they have the brand, they have the resources, but they actually have a really kind of ancient IT siloed system and infrastructure, which is very difficult to operate when you're trying to open data up for externals. They also have cultural silos, and regulation also doesn't help because regulators know how to regulate a bank. So if something goes wrong, they come after the bank right away. However, there's one type of player, which is my last point here, one type of player which actually has a lot of advantage here. And that's a new entrant that already has a brand name that is trusted. And it is digital born, meaning it relies on data analysis in order to give better services. And these guys are the GAFAM players. What we see is that in the last few years, GAFAM players have made a serious entry into finance. In the middle, you see Amazon offering loans to their small to medium enterprises, the sellers on their platform. Up on the left, you see Google announcing that they will provide checking or current accounts in the US already in mid-2021. Facebook has just announced at the bottom that they will have a fintech toolkit, and they already do peer-to-peer payments in many places in their platform. And Apple, of course, has their credit card, and they're doing payments. Apple Pay is one of the most popular mobile payment systems in the world. What does this mean overall? It means that big tech platforms are coming into even regulated industries. And this shouldn't be surprising because their data analysis capabilities give them advantages to give better services, especially when existing players have not been innovative enough. We see this on the left here in the case of healthcare. The UK national healthcare provider, NHS, signing up a deal with Google to share data in order for Google to then give them AI-based diagnostic services, which can save lives and save a lot of money. In the middle, you see Google taking over classrooms with their, my son and daughter actually have tablets in the school, and I don't allow them at home, but they get a tablet in school because Google just offers them to the school for free in turn for collecting data from students. And on the right, you see Amazon offering pharmacy and drug services as part of their retail platform because that's what they're good at. They have the distribution channel. Overall, what we see is that even if you try to open up markets, regulated markets, in order to boost innovation, sometimes because you're opening them up also to the tech titans, you may be making the market even more oligopolistic before. So that is a very important regulatory takeaway. In addition, for existing players that are in these markets, the fact that you're currently dominating the market does not mean that you will survive tomorrow, because as the famous book by Clayton Christensen, who recently passed away, says, it's typically those services that are not profitable at the beginning for big players that actually sneakily grow and become big in the market. And finally, even if you understand this and if you want to collaborate with new entrants, that's not always very easy because those guys don't have the reputation, don't have the technical expertise. And if something goes wrong, your reputation gets affected as well. So I have spoken a lot and I apologize if I went quite fast. This was what I wanted to say, and I am very happy to take questions now. Thank you.
Thank you. No, thank you. It was like an abrupt entry into what Oxford might also mean. So if you're curious about how that is, there's programs that you can follow on Oxford. By the way, tomorrow at 12 Romanian time or 10 London time, we have a special panel on hybrid education from Oxford with Pegram Harrison, Senior Fellow in Entrepreneurship, Maria Rotuliu, MBA candidate and Managing Director of Oxford Seed Fund, and Sorina Campan, Partnerships and Stakeholder Engagement Lead at SBS. I have about 412 questions, so I think this deserves another, and
Let's get more.
we don't have a lot of time, but you talked actually, on Tuesday we had a CEO of Raiffeisen Bank who also operates in Turkey, if I'm not mistaken, and he said something about fintechs that it follows me. He said something like, a fintech is like a friend you go out for, I don't know, like a beer, and a bank is like your best friend that helps you with furniture and comes to your wedding, etc., etc. But you talked about another friend, which are these platforms. So I was curious, if you look 4, 5, 10 years into the future, what do you think the relation between banks and let's call them platforms, Amazon, Facebook, etc., is going to be? Do you think there is a risk that banks need to take more into account?
Absolutely. First of all, I do not think that the big tech platforms are going to replace banks completely, because it's not economically advantageous for them to do so. It requires a lot of regulations and a lot of costs and compliance for an entity to become and serve as a bank. However, there are many services that they can actually get into without necessarily doing the whole thing. And that's really what's going to happen. What open banking regulation has allowed is that all these services, which we always associated with one bank, such as, if you need a loan, you go to a bank. If you need to transfer money, you go to a bank, right? All of it was all under one roof. Now it's being unbundled. And when it's unbundled, that means that the tech titans, the big tech platforms, actually can pick and choose the services that are actually for them economically more interesting, and leave those that are less interesting. So, for example, many say that checking accounts or current accounts are actually a money-losing activity, and you do that in order to entice the customer. And on top of that, you try to sell things like loans. Now, that's interesting, and it's interesting to see how Google is actually starting to offer that. It may mean that they're going to do a loss-making entry and then provide more. Yeah. So in short, what I want to say is that big tech platforms are going to offer us more financial services as integrated into whatever platform they're on. But banks are going to exist as well. And it may be that we keep our money at the bank, but we do a lot of financial services on big tech platforms in the future.
As a professor of entrepreneurship, what advice would you give young entrepreneurs related to the fintech, let's call it, domain? What would you say to them?
Well, one of the things that we notice as particularly challenging is that a lot of fintechs are basing their business model on artificial intelligence, which is wonderful because that's something that the big banks don't do. As I said before, they actually are afraid of touching data. The problem is that new entrants have difficulty accessing data because customers typically don't know these guys and they don't trust them. So one of my first advice for a fintech company is know where you're going to get data. And if you don't immediately have access to it, then build those partnerships that will give you the data early on. And it may be that you go to a credit agency. It may be that you go to a lending platform. But first, figure out your data bottleneck and resolve it before you go in the market.
Yeah. And one final question or two. When you look at the UK now, this is nothing to do with your speech, but I think this is something that we all need to address. UK is one of the biggest innovation hubs, let's call it, in Europe. And it left the European construct and the European Union. Do you think this will have an effect or an impact on the way entrepreneurship in fintechs, and not just fintechs, happens in the UK, or is it, on the contrary, a boost of some sort?
Unfortunately, I cannot say that it might be a boost. And the reason for this is that when these fintechs find it more difficult to internationalize because of different regulations, and over time, you can imagine that these regulations will go more and more apart. That will be natural. It will be more difficult for small players to globalize quickly to reach critical mass in order to survive. And that's something that's going to be difficult. And from an entrepreneurship point of view, that is what I'm sad about.
Yeah. So what are you happy about? What are you excited about when you look at 2021? We had a lot of people in the summit so far, from the World Bank to Romanian ministers to big businesses around the world, from Singapore to everywhere, Colombia, and everyone is very optimistic about the future, about 2021.
Mm-hmm. Well, in a sense, things can be much worse than 2020, right?
That's very good.
The only way to go is up. But I mean, actually, seriously, when I look at fintech and when I look at entrepreneurship, I am very hopeful and I'm very glad, because what I see is that, in the past, a large majority of the population that had financial debt and, financial illiteracy, they didn't understand how to manage their finances. They're finally getting these services to them. And things are becoming easier to understand because fintechs are trying to reach these customers. And the only way to do that is to offer something that is better than what the bank offers. Yeah. And so I'm very excited as a professor of entrepreneurship, because I know that in the future, people will be handling their finances better. And therefore, societal welfare, our mental health, our physical health is going to get better because we're going to have less financial trouble.
Yeah. And one last question from me. The next panel is going to be in Romanian, and it is in Romanian because we talk about digitalizing public services in Romania. And you do come from a country, Turkey, not just the UK, which has had a variety of ups and downs, let's call them, in digitalizing public services. What advice would you give as a professor, but also somebody very knowledgeable about the digital world? What advice would you give to Romanian authorities to move forward and faster in this direction?
Well, I think that it doesn't have much to do with kind of Turkey versus UK or any other country. What we see is that a public sector needs to understand that data and collection of data and data privacy is something they have to deal with. And my advice, because you cannot really, in a sense, avoid the entry of big tech platforms into public sectors and into public domains like healthcare and education, etc., get on the ball of artificial intelligence early on. And if you are afraid to give data to big tech giants, which I understand there are many reasons not to, then work with entrepreneurs and actually support them in order for them to be integrated into the public sector, such that data is collected, analyzed, and therefore you can save lives, you can offer better education, you can diagnose issues in the classroom much earlier on. Get on the ball of AI as soon as possible would be my advice.
Good. So involve startups and companies in co-creating, let's call them, solutions for digital. Thank you so much. It was lovely to meet you. Don't forget, we meet again with awesome people from Oxford tomorrow from 12 Romanian time, 10 London time. Thank you, Pinar, so much. It was lovely to meet you. I hope we meet. We meet maybe next year in Oxford in the spring. The school event is always something that I look forward to. I hope this year we can have it and then rejoin the social entrepreneurs of the world in Oxford. Thank you so much. Bye bye.